everybody, Jason from Map Signals here. Listen, markets are in turmoil, stocks are crazy volatile. Some are 40, 50, 60% down from highs. We got crypto, going in the toilet. Like, what is going on? I think everybody wants to know, when is this selling going to stop? When are the markets going to come back? And more importantly, what is happening? So I'm going to address all three in this video. Stay with me. It's going to be a bit of a ride. I'm going to tell you right up front, I think this correction that we're witnessing is completely engineered by the Fed in a very intentional way to get us to a soft landing that everybody thinks is virtually impossible. So I'm going to walk you through that right now. Look, when stocks are puking and some of them are down 20, 30, 50%, I look in my brokerage and my stomach turns, right? It feels awful. And negative thoughts can creep in like, oh my God, this time it's different. The Fed is in over its head. The US has issued too much debt. It's insurmountable. The news is going to pile on, right? They're going to feed all this negative emotion because fear sells, not puppy dogs and rainbows. I'm sorry to break it to you. It's just true. Negative news sells way more than positive news. So they're piling it. So we're in the midst of this volatility. Things have kind of calmed down a little bit, but man, it is still nasty out there. So when is this going to stop? So as far as when this selling is going to end here, if you look at there's a lot of numbers here. So basically, this is finding every instance since 1990 that had similar selling to what we've seen. Long and short of it is it takes about 20 calendar days since the selling starts to when the market troughs. That basically tells us February 11th should be the market bottom based on 30 years of history. Now, some days it could be more, some days it could be less. Naturally, we don't know. What's really important is look what happened after 1, 3, 6, 9, and 12 months after markets were very positive. So first and foremost, it's a bullish thing when selling comes to town for the longer term. Once we get through it, we're going to be great. Now, I know you're all wondering, are we going to get through it? That's what I'm going to talk about right now. So when thinking about the big picture, I asked myself, hey, what would I do if I were chairman of the Fed, right? Our hands are tied, right? We flooded the economy with money for a long time. The housing market, the great financial crisis, all that stuff for years. When rates were finally rising, COVID hit. And I'm the Fed. I had to rescue the economy. We had to work with the US government. We had to provide payroll protection loans, EIDL loans, government stimulus. We had to buy bonds. We had to flood money into the system so everything didn't collapse, right? So we were just getting back to the point where we could finally maybe start to raise rates enough to make a difference, and boom, we're worse off than we were before. We were told to stay home. You can't go to work. You can't go to your kids' schools. You can't do anything. You can't buy pizzas. Businesses shut down. Labor crunched overnight, right? And government stimulus helped keep it all afloat. Okay. But with all that money in the system and labor shrinking, guess what? Labor forces seized up supply, like supply chains. You know how hard it is to get a fridge or anything you order now, right? It's impossible. Okay. But there was a lot of money in the system chasing little supply. So what happens? Those prices rise and we get wicked, crazy inflation. That's what we got now. Okay. So I'm the Fed. How do we fight it? Everybody's going to tell me, Jay, you got to raise rates and you got to raise them a lot. It's going to hurt and it's going to stink, but you got to do it, right? Wrong. Is that my only option? No. People think the Fed only can raise rates and stop their bond purchases, and that's the only thing that happened. Goldman Sachs is out there saying, hey, the Fed's got to raise 5 to 7 rates hikes this year. JP Morgan, Jamie Dimon, the CEO, is out there saying, hey, expect wicked, nasty volatility. Expect it for the rest of the year. And if we're lucky, maybe the Fed can engineer a soft landing. Maybe, just maybe. The rhetoric is out there, and people think all I can do is raise rates. But no, Think about it this way. The US balance sheet has $30 trillion of debt out there. Simplifying immensely, if we raise even 1%, that's what? $300 billion of interest that we're raising ourselves. So we can't shoot ourselves in the foot, right? We do too much too fast. We risk pushing everything into a recession, right? We do too little, inflation runs away. Our hands are tied. But because of that debt statistic I just told you, the Fed can't raise too much, and certainly not too fast, even if they wanted to. So like I said, what would I do if I were the Fed chair or the Fed? The policymaker, the body that affects 380 million Americans and arguably the entire world's financial policy. Every single word we say, every word I say if I'm the Fed chair, has meaning. That's why you get some crazy moves. And that is exactly what wrote the playbook to fight this inflation right now. Now, long ago, Alan Greenspan in a 1996 speech said the words irrational exuberance.
How do we know when irrational exuberance has unduly escalated asset values?
Immediately, the Nikkei fell like 3.5%. World stocks tumble. And they interpreted his words as like, oh, there's a bubble, and everybody sold everything. It was disastrous. Now, Ben Bernanke only just hinted at tightening potentially at some point in the future, tapering the bond purchases out of the housing crisis. That was in 2013. Guess what? Taper tantrum happened. Bond markets got smoked. Stocks got rocked a few months later in the spring, and everything was tanking just because of a couple of words. I think that is the exact playbook that's going on. I think we have taper tantrum 2.0. Because to fight inflation, we got to take money out of the system. Yes, we can raise rates, make everything more expensive. We can stop buying bonds. But again, we don't want to hurt our own economy. So what happens if we just go out there and say, hey, we might have to raise rates more aggressively than we thought and taper bond purchases sooner than we thought? People are going to freak out. First of all, they're going to stop buying stocks. Then the sellers are going to come in and push everything down. If there's no bid, where does it go? Down, straight down, like it did in January. Okay, this is a taper tantrum 2.0, and I think the Fed's language in their December meeting minutes where they said those words, more aggressive or faster than anticipated, is doing the heavy lifting for them. Because how am I going to fight inflation? I got to lower asset prices. Well, imagine if I say some language that's going to take stocks down, and crypto, those speculators in that market who used leverage to lever up, I'll explain that in a second, have to sell. And all of a sudden, your brokerage, my brokerage is down 20% or 15% or whatever shape you're in. You're going to think twice about spending. Maybe I don't need that new TV that I've been holding out for. Maybe that expensive vacation, I'm going to do a smaller version. Maybe my kid doesn't need XYZ. Let's just reel it in. Isn't that exactly what the Fed wants? Lower asset prices, less spending, lower consumer prices, cooling inflation? I think so. Remember what I just said, speculators in stocks. So Robinhood came out last year and they admitted on TV, they were like, yeah, we're seeing a lot of $600 and $1,200 deposits in 2020. Those were government stimulus checks. Not everybody, but some people were taking the money from the government, opening Robinhood accounts, and then levering that money, meaning I'll put in $1,200 and I'll borrow another $1,200 to have $2,400 to control and trade. Guess what? They went and they bought meme stocks like AMC and GameStop. Remember how those things were zooming through the roof? And some of them went and bought crypto, maybe not on Robinhood, but a lot of money went into the speculative markets. Hey, it made it look easy to make money. But guess what? It was really the government helping to lift asset prices. So what do I do about that? I use some scary language saying I'm going to tighten faster than expected, and all of a sudden both those markets come tumbling. Those people were using leverage. They get margin calls. They got to sell out. That might have been an alternate income for people who were staying home at work. and even getting unemployment benefits and child care credits and all these aid instruments that the government was offering that they have now turned off for the most part. So you got no government aid, you got no money making from crypto and stocks, you got to go back to work. But hey, there's still COVID, right? Well, that's where I think the next few weeks are going to be key because, listen, I think President Joe Biden's going to come on TV. He's going to ceremonially take his mask off and say, America, we beat COVID together. It's no longer a pandemic. You got to be vigilant. You got to get vaccinated. You got to get your boosters. And, I still encourage wearing masks in tight spaces or whatever. But hey, the numbers are down. We did it together. Let's get back to work and let's rebuild America. He's going to say that, I think, in 8 to 12 weeks. His approval ratings are really low right now, so his ratings are going to go up. Everyone's going to cheer, and stocks are going to go back up too. Now, if I'm the Fed, so far, I still haven't even had to raise rates. I just had to use scary language, get asset prices to fall. And I'm not going to do that until I know there's a catalyst to get the market stable and the labor market can resume. And that is going to be that announcement that I think is going to happen. And what will that do? The people who no longer have access to easy money and need work are going to have no more fear in place to go back to work. The labor market is going to lift, right? Jobs are going to come back into play. Supply chains will start to thaw, I think, sometime in the third quarter. It's going to take a while, but we're going to start to see. So already asset prices are falling in stocks. They're falling in crypto. People might be spending less, right? They're going to go back to work. The labor's going to go up. Supply's going to start to go up. So it's now a two-pronged approach. And again, if I'm the Fed, I'm not making this recommendation until I know we have the engines of a real economy coming online, and that's that COVID announcement. Now, I'm the Fed. I'm out there saying scary language in December, meeting minutes in January. I released those stock slid and all that stuff. I need agents to help me. So Goldman Sachs is out there saying we expect 5 to 7 rate hikes minimum. And JP Morgan, like I told you, he's saying expect volatility, and if we're lucky, we're going to get a soft landing. I want to remind you, JP Morgan bailed out the U.S. government. I think it was in 1897, before there was even a Fed. James Pierpont Morgan himself flooded and backstopped the U.S. government. And then again in 1907, they rescued the U.S. economy itself. JP Morgan is a very right-hand man of the U.S. government and now the Federal Reserve Bank. Goldman Sachs, need I remind you, in the housing crisis, Hank Paulson left as chairman of Goldman Sachs to go become the U.S. Treasury Secretary to help rescue a calamitous situation. He engineered TARP, the Troubled Asset Relief Program. Okay? He, by the way, got to sell all his stock tax-free. When you go work for the government, you get to do that. So Goldman is hand in hand. And right now, I just want to remind you that a Minnesota Fed chair who worked on TARP way back when with Paulson is expecting 2 rate hikes this year. Goldman Sachs saying 7. Someone within the Fed who worked on TARP, ex-Goldman, is saying 2. So let's get my buddies out there to spread bad news and push asset prices down even more. Let's give the people the pain up front. Now, who are those people who get the pain? Because you're hurting, I'm hurting in my stocks. But if I'm a 401k investor, I'm actually buying more shares lower right now, and I still have years to work. If I'm already close to retirement, I'm mostly out of equities and already into bonds and fixed income. The people who are really getting hurt are those speculators, those guys levering. So, in my mind, in the Fed, if we're going to prick some bubble, it should be the speculative bubble. Guess what? I'm the Fed. I didn't even have to raise rates yet. Everybody's expecting it. All I did was take money out of the supply using ghost policy. I didn't actually raise rates or do anything yet. In theory, I do believe the Fed is going to raise rates 3 times this year and get our target rate to 0.75 to 1%, the federal funds rate, by the end of the year. I want to remind you, even if hypothetically, and this would be very bad for the US economy as well as the balance sheet, if the Fed raised rates 8 times, or let's just say we got to 2%, we would be back at the summer of 2019 level when the target rate was 2%. And the economy was humming along and everything was going well. We obviously had to drop it to 0 once COVID hit. So here's the deal. This is what I see as happening. Q1, pop the asset bubble, take prices down, allow a little volatility. Sometime in March or April, get President Biden to announce the end of the COVID pandemic, get people back to work. So Q2, people are starting to work. The labor supply is starting to fill out. Q3, the supply chains are going to start to ease. Things are going to start to feel a little bit more normal. This is going to be a longer process. And I think in Q4, we're going to get a big lift in growth stocks. Why? Because growth stocks have been absolutely pounded in January, anticipating a much more aggressive policy than is really going to happen, in my opinion. So these stocks were overpunished in January. They're going to lift a little with a COVID announcement, but what's really going to make them regain a lot of their value is people, the market, digesting and realizing that the Fed is not going to raise 7 times. They're not going to be overly aggressive, and they're not going to shoot America in the foot because they can't. But what can they do? They can use a 3-pronged strategy, working in concert with what is on the horizon by the government, to engineer the very soft landing that many people, including Jamie Dimon, CEO of JP Morgan, says we're going to be lucky if they do. But I think they're doing it right under our very eyes. And I personally believe now is a buying opportunity for stocks, especially growth stocks, because they're under some immense pressure. But all this rhetoric and all this negativity is causing asset prices to go down and take money out of the system. And that is how I think the Fed is removing the froth. They have to take out, there's too much money in the system. They're high-priced speculative assets. Stocks with growth multiples were sky high. Got to take those down, and you got to take leverage out of the system. This is a perfect way to do that, in my opinion, and they don't even have to act. And they will act, but it's going to be far less aggressive than everybody's making it out to be. So we're going to get a lift at the end of the year. And me, as the Fed, I get the market to do the heavy lifting for me, right? The US wants to emerge from COVID on top, not out of the frying pan into the fire. And I think what we're seeing right now is saving us from that. So let's just recap. I think Q1, we have tough talk that tanks assets. Q2, our markets are going to stabilize a little bit because we defeated COVID. Bravo. Q3, labor booms, tightened supply eases, and we get back to more normal economic activity. And Q4, stocks are going to finish strong, led by a big Phoenix from the ashes growth resurgence. And I think, throughout this coming year, Fed in 2022, the Fed is going to reduce their bond purchases, and they're going to raise rates to a target rate of 0.75 to 1.0. That is the playbook that I see for when is this stock market sell-off going to stop? When is it going to come back? And what is really going on? The soft landing that everybody out there, the pundits are talking is virtually impossible, is happening right now in front of our very eyes. Again, that's my view of how things are panning out. It might just be a mass deception that's being perpetrated on all of us. I know that sounds crazy conspiracy, but think for yourselves. What would you do if you were the Fed chair? How would you fix this problem? I think you get your buddies, you use some tough talk, you use the tools that you must use, save it for last. Try everything else first. I think that's what's happening. So that's why I think now is a great time to go deal diving for growth stocks that have been just punished, because I think they're going to see a huge lift, especially in Q4. So that's it. Is it a mass deception? Am I crazy? I could be. I could be totally crazy, or I could be right. And if I am, I think it's a great time to find these deals. If you want to find out more about how to find those stocks and those deals, head on over to mapsignals.com, sign up for our free blog. You'll get insights like you get nowhere else. And also like and subscribe on this video. If you liked what you see, please leave comments. It's pretty provocative. I want to hear what you have to say. Thanks for everything. I will see you next time. Bye.